Hey, I'm Jim Keaty with Keaty Real Estate, and this is Real Talk with me. And today I've got my really good friend and mentor, Mr. Bill Bacque, who's going to break down the entire Lafayette Parish and Acadiana market update for us. So, Bill, thank you so much for taking time out of your day to be here. I consider you the expert or the oracle when it comes to real estate data. I was just telling you I cross-reference all of my data with your data to make sure we have everything right. So welcome to the show, and thank you for doing this.
Well, I'll tell you what, with that kind of introduction, I want to come back again.
Well, we hope to have you.
I have had this kind of an attraction to numbers, going back to grammar grades. And this is, I guess, the fruit of that interest. But I do find that one of the things that is most important in the real estate industry is to be aware of what's going on, not just at the curb level, which is what you or your agents are experts at,
right.
But also having kind of a view of what's going on in the marketplace from what I call maybe the 2,000-foot level. Now, if we read newspapers or watch the news, we get from national media what you might call the 10,000-foot level of real estate, where they say nationally prices have gone up X%. How much relevance that actually has to what's going on to your home in Lafayette, Louisiana, is generally minuscule. It's real estate is, to a large degree, a local economic impactor. Now, there are things that can affect the real estate market across the board throughout the country. Those things include interest rates, and they can include things like that are in the news now, like flood insurance rates, things such as that. But as a general rule, you want to have some idea in the marketplace of what's happening overall, as well as what's impacting your home specifically.
Right, and it's a 2,000-foot level because it's our region, but really real estate, like we've talked about this before, it's hard to give you generalities of the market in Acadiana when really, if you really want to know what your house is worth, you got to go to that micro level at in the neighborhood, right?
You can't use one indices to the exclusion of the other. You have to have them all fold together to have a pretty good grasp of at least the market conditions at that present moment. And I stress at that present moment because things change. They can change dynamically even within a 30-day period, especially now, because of the low inventory market that we're dealing in. So in certain price points, a movement of 2 or 3 sales or even 5 listings can make an impact on what your position is in that price point in the marketplace.
Well, we've had a lot of changes just in the last 24 days. So let's jump right into it. Let's, what are you seeing out there? What should we expect? What does the market look like today?
Well, interestingly, if we go back to my last report was February. We're doing this at the end of March, and so we have one more day, actually 2 more days, today and tomorrow, for sales to come in till we get our March reading, and then we'll have a quarterly group of numbers to analyze. But through the first 2 months of this year, not a whole lot of change or dynamic change from where we were last year. What we are seeing a continuation of overall in Acadiana is a lower amount of inventory available for sale. When we talk about Acadiana in general, overall, which is inclusive of Lafayette Parish and the surrounding parishes, at the end of February, we had about a 1.7 month supply of product. And what does that mean? Well, that means that if you had based on the amount of demand that you have for the first 2 months, what would it take based on the current amount of inventory to sell that inventory?
Right.
And so on overall, we have about a little less than 2 months worth of inventory available.
Repeat that one more time for the people who don't know what months of inventory is, because it's very important.
Well, it's an interrelationship between supply and demand. And what we do is we take the average amount of sales that have occurred within the whatever the period is. So if we're dealing with, let's say we're dealing with January and February, and we're dealing with 100,000, 100 to $110,000 property. Over the first 2 months of this year, there have been 11 sales. As of February the 28th, there were 10 active listings. So based on 11 properties selling in 2 months, how long would it take to absorb 10 properties that are on the market? And the answer would be 1.8 months.
Right.
So there's a 1.8 month supply of product in that particular price range. Now, 1.7 overall. Now let's take the contrast. If I'm dealing with a $500,000 house, there have been 10 sales in the first 2 months. And as of February 28th, there were 20 houses that were active on the market. So we have a 4-month supply of product in that price range. So that gives you the contrast to see that even with an overall 1.7 month supply of product, if I make that statement about Acadiana, that's a correct statement. But if I'm an owner of a $500,000 house that's on the market for sale, that statement is irrelevant to my position in the pricing pyramid.
And so overall, we're at right now we were at 1.7.
That's correct.
And what does that mean in relation to, what is average? Like let's break down the supply and demand. Like if we're at 1.7, is that a seller's market, a buyer's market, or a neutral market?
I would say it's a seller's market. And that being said, the traditional the traditional economic thought relative to number of months supply of product was that somewhere in the 5 to 6 month supply of product on the market would be generally classed as what we call equilibrium. And what that means is there's enough demand and enough product on the market to where those forces essentially equate to one another or equal one another. And so there's not too much pressure upward on price, nor is there too much pressure downward on price. Prices tend to stabilize. Okay. The opposite occurs as your number of months supply goes up. What that means, if I have a 10-month supply of product on the market, is that it's above equilibrium. That means there's more product on the market than there is demand. That tends to pressure prices downward. Okay? Conversely, where we have been in and have been in for at least the last 8 years is a declining market number of months supply product. And the more you get lower than 5 to 6 months, the more it's indicative of a seller's market. Prices are tended to be pressured upward because there's a lack of demand relative to supply.
And what we've seen too, and I'm sure you're going to show us, is that we've also had more sales. So it's not from a lack of houses coming on the market necessarily as much as it is more demand than supply.
Absolutely.
And that's the fundamental of real estate prices, is this concept of supply and demand. So that's why it's such an important topic.
We're always going through it. Okay. When you have periods of dynamic change, it becomes more and more important. But clearly, when I was actively involved in the brokerage business, I would coach my agents to say, you need to know each month what's happening to the number of months supply, not just overall, but in certain price points that are relative to the interest of your client because those change on a monthly
Right.
basis. And so one of the things that clearly one can do if you have your property on the market and you're not getting any kind of positive response, then there's always the pressure to move your price downward. What I wanted my agents to be armed with is information that might show what would happen if we reduce the price by looking at the number of months supply of product in your price point. Well, if I moved it down to a lower price point, am I going to have a lower number of months supply of product? If that's the case, that means there's less supply relative to demand in that lower price point. That is at least a rationality for making that reduction. If, on the other hand, I reduce my price and I go into a price point where the number of months supply is greater than the one I'm in a weaker logical position to argue that price is the driving factor for what you need to consider.
Right. No, it makes total sense. So right now we've got low inventory. I mean, just since March of last year, it really started decreasing, and now we're at a point where it seems to have almost stabilized, if not going up as far as supply.
Well, actually, it's been going on for longer than that, Jim, and I found it astounding. And I pulled a report that I did at the end of December. At the end of 2011, and the number of months supply of product for Acadiana at that time, that's 2011, so we're talking about roughly a decade ago, was 7.6 months supply. Okay, last month it was 1.7.
Right.
Okay, so we have been moving in this trend of more demand than we do have supply. That's not dropping supply. It's just that the demand has been increasing at a greater rate than the supply increase has occurred. And that has, as you pointed out, though, really been exacerbated in the last couple of years. And there is a slide that looking at the screen, you can see this graph basically takes us from 1982 all the way through 2021. And these are all of the parishes that make up Acadiana. So these are our total sales. And if you look on the far right, which is the more recent, just take a look at the last 3 years. Where we've come, especially 2020 and 2021. Sales just shot up. Now, one can argue that that's the COVID effect, if you will, that the lockdowns that began in 2020 ultimately created a pent-up demand that once those lockdowns ended in March of 2020, we saw sales just go over the top. And coupled with that was lower interest rates that were a result of the Federal Reserve's action to combat the economic impact of the pandemic.
Which we want to get to later, too, because that's a big topic right now.
And then there was government stimulus that came in 21, in June of 21. People were getting, $6,000-$8,000 checks from the government. So we were suddenly flush with cash, low interest rates. Kids were at home driving us crazy. And we were at home because we couldn't go to work. We finally decided, the Millennium generation, who's that next big bubble coming along, finally got off their duffs and went out and started buying houses. I think that was part of the impetus that saw us basically rise from a $5,000 sale level in 2020. In 2019, to go all the way up to over 7,000 sales in 2 years.
Right. Well, what does it look like where it's going now?
Well, one of the things you can see from this long-term chart is that although owning real estate, the sales, the trend line has always been relatively positive. Nothing goes up and down straight.
Right.
Okay. And we're going to have peaks and valleys. And so when you get into areas or times of tumultuous change, if you're going to have rapid rise, you can't expect that to continue on. Mm-hmm. So last year, for example, in Lafayette Parish, we had just under a 20% gain in the number of sales that have occurred. Through February of this year, it's about a 7% gain, 7.5% gain. So the percentage rise is beginning to level off.
Right.
And there are some reasons to believe that was going to happen anyway. Mm-hmm. But now with some additional influences, I believe that it's going to be very challenging for us to exceed what we did last year.
Right. Well, what about the volume? So I know that like sales have gone up, but we're also seeing our volume increase more than even the percentage of the number of sales.
I do have a volume slide here.
Yeah. Like the white, that one.
I'm trying to do it on. Okay, here's your dollar volume.
Yeah.
Okay, so again, making the contrast between the sales, which zoomed,
right,
and the dollar volume, which also zoomed, but that dollar volume went up to a greater capacity than did the sales.
The number
As you
of
can
sales,
see
right
here, the actual dollar volume, a little over $1.7 billion in sales, was up 30%.
Right.
A little under 20% in units. So clearly what that indicates is that what people were buying were more expensive products.
Right.
And why did that happen? Well, they had more cash in their pockets, stimulus. They had lower interest rates. As a matter of fact, interest rates were historically low in 2022.
Right.
Historically meaning they were lower than they ever were before. They were under 3% interest rates.
Right.
Okay. As a matter of fact, as early as December of this past year, you had interest rates that were under 3%. Mm-hmm. Today, they're 5%.
Right.
Okay.
Which, is higher than all of the experts have predicted over the last 12 months that we would be at right now. They predicted to go up, but not nearly as fast as the Fed raised the 10-year Treasury yield.
Right. Well, the anticipation was that the Fed would be much slower in reacting to this inflation factor. But the numbers have been critical enough, inflation numbers, that the Fed has decided to act at a more rapid pace. And yeah. I believe that they're doing the right thing. It may, in fact, long term, they're doing the right thing. In the short term, it's going to hurt the real estate business, or it's going to have an impact negatively on the real estate business. That being said, we're coming from a level of such a level that it's hard to be too negative about a marketplace that might not equal what it did in 2021. Matter of fact, when I made these presentations back in January, even before we started to see the impact of the rate hikes and everything else, I made a prediction because of where we'd come and how far we'd come over the last 2 years. I said, it's my prediction in 2022, and I have it written down on a little piece of paper, and I'm going to keep this little piece of paper, that we'd have a 5% decline in 2022 in the number of sales. Okay, that would be about a 365 sale drop. That would drop us to 6,940 total sales. Okay, that still would be 12% ahead of where we were in 2020.
Sure.
Okay. Yeah. So everything's relative. If you're sitting up here in the stratosphere, okay, you can't expect to be there forever.
Right.
There is an economic gravity that brings things down, and we're going to see that happen. But if that happens, it's not devastating. likewise, I continue to think in terms of people buying higher priced homes. And so I only anticipated a decline, well, actually, it was a little bit more, 8% decline in the dollar volume of that real estate. That would be about $137 million drop. Sounds like a lot. That would then make this 2022 the second highest a year on record for dollar volume. Right. So everything is relative.
Yes.
Are we going to have some course correction? The answer is yes. Is that course correction going to be the same across the board, regardless of price points or areas? The answer is no. Right. It's not. Probably not. It's never perfectly distributed.
Yeah.
Okay.
Well, and as you said, so the volume, we can take from it, the houses that they're buying are more expensive, which is in turn increasing the average price sold, which was influenced by the lower interest rates, the money in their pocket.
Right.
And, so now that interest rates, I've never seen them, in this short of a period go up from as fast as they have, as far as I can remember. And maybe you've experienced it faster, but just in the last, 60 days, we've seen a major correction in the interest rate.
Yeah, and I guess there's two ways to take that. I mean, you basically have seen interest rates double, or not quite double, but let's say December they were close to 2.5, and now they're 5. That would be a double. Okay. Right. From a percentage standpoint, you're right. That's something you don't typically see, but a couple of points in increase in rates. Have we seen that before in a relatively short period of time? The answer is yes. So the impact percentage wise is because they were so low.
Right.
Okay. That
the percentage is such a high percentage.
That's exactly right.
But as when we went from 5 to 6.5, it's happened before.
Right. And I do get it. There are a lot of what we might call old fogies like me that were in the business, the real estate business, been in the real estate business for 50 years. So I was around in the 1980s, and I hear some of my contemporaries and myself sometimes let it slip to the younger people that are in the real estate business that, when we were in the business back in the 80s and 90s, we had 18% interest rates, and we were selling houses back then. So what you complaining about? Okay. Yeah, that's the case.
Andrew, let's pull up. I got the historical data on my slide. Pull up the interest rate projections, and I think it's going to be slide 10 and then slide 12. So speaking on that, people are talking about, you were just saying the historical data, where back in the 80s, right. the average over that decade was 12, but there were periods where it was 15, 16, sure. 18%.
Sure.
And then so, even at, approaching 5%, we're still way below what the historical interest rates have been over the past 5-10 decades.
Absolutely. So, it's not necessarily reality.
Right.
It's what you're conditioned to, that you perceive to be reality.
Right.
And one of the reasons why the impact of this move in interest rates could be more significant than we would normally think, okay, is because people have been conditioned to lower interest rates for so long.
Right.
Granted, the historic lows have only been for a little over a couple of years through the Fed's actions on COVID. But prior to that, going back to 2008, the Great Recession, interest rates, that's the last time the Fed intervened into the securities market and ultimately influenced interest rates in in an attempt to raise the economic prospects of our country. And so people have been conditioned to relatively low interest rates, where back then they were in the 5 to 6% range,
right,
where they are now, which again, historically was relatively low, okay? And the 2010s went actually to 4, okay?
Right.
That people got conditioned to that. And when you think in terms of a decade of conditioning to that kind of an interest rate, that creates an impact when interest rates suddenly rise to 5 to 6%. And we don't really consider how impactful that can be. But it's a two-sided sword, or two-edged sword. On the one hand, it impacts buyers,
right?
Because every time the interest rate goes up,
that's right,
their monthly payment goes up, and what they qualify for as a loan goes down.
Right. I mean, most of our clients, unless you're paying cash, the price of the house isn't as important as what it costs.
It's
what's
my monthly note?
So we got pressure on the price going up because the same house 2 years ago is now almost half that price, where it was when it was in 2.5%. Right.
You've got the impact on the buyer in buying. Certainly the interest rate going up impacts on how much they're willing to pay for a home, because they got to qualify for that, and the monthly payment is impacted. But on the other side of that coin, think in terms of the sellers. We do have a certain number of sellers who are first-time buyers who don't have existing debt, or at least not mortgage debt. They don't have a home that they have to get rid of. But for much of our marketplace,
what do you mean first-time buyer? You mean first-time sellers?
No, first-time
buyers.
Sellers. First-time buyers.
Buyers,
because a seller who sells, unless they're moving away, is going to buy.
Right.
Okay. Unless they're a first-time buyer. Okay, where they don't have something to sell.
Right.
Okay. But there are quite a number of people. As a matter of fact, the general the general path for most of us through our home buying years is we start off, we buy our first home, we live in it a few years, we sell it, we buy a bigger home, and we move up that gradient, if you will, till we go to our last home. What we found is that over time, demographically, what's happening is people are, number one, owning their homes longer. Okay, where just less than a decade ago, the average home in the United States was owned for roughly about 5.5 to 6 years. It's now going up to roughly 13 years before you're selling. Okay.
Yeah, I mean, just in 2000, in the early 2000 teens, I mean, it was 8 years, and now it's 13 years.
Right. So here's what's happening is that part of that is the interest rate impact, that people, because of their affordability and lower interest rates, were skipping maybe 1 or 2 steps in that acquisition.
I see.
I'm buying a much bigger house because I can afford a bigger house because of interest rates. Now, let's suppose I bought a house 5-6 years ago. No, 5 years ago, and I have a 4% interest rate. Okay, it's 5-6 years later. Added some new bodies into our family. We need more room. We want a bigger house. We want to go out and buy a home, but we got to sell the house that we're in. Okay. The problem the challenge that we're going to have is to buy a bigger house. Not only do I have to pay more because it's bigger, but because the interest rates have gone up, my cost to buy that is bigger. And I'm now putting my house on the market, and I have less people that can qualify for my house that I bought because the interest rates are higher than the one I have to sell. That's the conundrum that we can run into when we have major changes that are occurring in the marketplace. And we need to be prepared for that. Again, I don't want to be the harbinger of doom.
How do you prepare for that? Because I hear what you're saying. So, for instance, my wife Danielle and I, we had James, my son, and we needed a bigger house. So we bought a much bigger house than we could have bought 5 years ago, as far as in value, because we could afford more because the interest rates were low. Well, I could understand where, the house that we're in today, I don't think we'll be able to afford it. If interest rates go up to 6, we will not be able to afford the cost of that house on a monthly basis 3 years from now.
Right. So let's take a look at Acadiana and draw a couple of contrasts between the 90s, 80s and 90s and today. Back in the 80s and 90s, we had all the major oil companies that were here. Mm-hmm. There was a significant amount of relocation business that was coming in and out of Lafayette. That is, people coming in to buy, were not tied into existing property here. Mm-hmm. Okay, that added a lot to our overall real estate industry. Today, with the exception of potentially the medical community and several other smaller businesses, there's not nearly as much relocation businesses that comes in. Right. So our marketplace is a self-generated marketplace. And again, if you already own real estate...
Say that one more time.
It's a self-generated marketplace. Mm-hmm. That is, people within our market are typically what makes up the population of buyers and sellers in our market.
Right.
Okay. And so ultimately, if in fact that's the case, and you're not bringing people in, most or many of those people, unless they are first-time buyers with no existing real estate ownership, they're burdened with a home that got to sell in order to buy. And so the idea of interest rates only impacting a buyer's ability to buy without it having an impact on a seller is losing about half of your perspective.
Right.
And so what do you do about that? It becomes much, much more important to become price sensitive. In what I believe is going to become the coming market. And it's going to be more important to do that because over the last 2 years, sellers have become conditioned to beating buyers over the head with everything they've got. Buyers paying more than the list price. Buyers are not doing inspections or waiving inspections, waiving appraisals. They're doing crazy things.
So just to point out, I don't mean to interrupt, but this is just in February, the percentage of homes that are selling over list price. So although interest rates have changed, it just hasn't impacted the closings like we talked about just before this podcast. But so 19% of the homes in February sold for above list price. And if I go back to January 2021, you can see April of 2021 is when we saw a significant jump in that kind of environment,
right? Which
we just weren't used to, and now it's become, as you can see, we're almost the last 12 months we've seen double-digit sales above asking price.
Yeah.
So it's interesting.
And again, it doesn't take a very long period of time for those conditions to exist for someone to believe the abnormality of the moment becomes the normality of now, okay? So they're conditioned to think that this is normal, okay? Right. It's not normal, okay? And so what we need to be able to do, because there's a transition period, particularly for sellers in a seller's market, for them to learn, okay? And we have to be able to have that kind of data available to them. Not that it's going to instantly turn on the light. You're going to have to condition them on a regular basis to see how that market is changing so that they can ultimately adapt to that. Because again, my job is not to produce a buyer. Real estate people don't create buyers. We just don't have that power, okay? But what my job is to manage the expectations of my client, be that client a buyer or a seller. Right. And the way that I manage their expectations is to try as best I can to educate them to what the market conditions are within the realm that they're dancing in.
That's right. And we're in uncharted territories because we're still got the high demand. And we talked about this a second ago. There's so much to unpack here, and there's so many different things to really dive into. But in order for the impact of the interest rates on the demand, we have to see what happens, but we're not seeing that. You had said just before we started, and your numbers indicated that March is looking like, which we don't have the final numbers yet, we're still a few days out, but March is looking like we're going to have less pendings on the books versus last March.
Yes.
But I would argue, I know at our office, we have so many buyers, but there's not enough inventory. We would sell way more houses in the under $300,000 price range if they were available. We would have higher numbers, but because of the low inventory, and what was interesting is in February, let's see here, February, we had less new listings come onto the market, and these are coming from your reports. So not only do we have high demand, we have less new listings coming on the market, which was not necessarily the case last year. We actually had more new listings come on the market, but the demand was just eating it up before it could really affect the total active. So now, as of February, we had less new listings hit the market, we had more demand, and we had less sales, but we also could have sold way many more houses if we had the inventory to sell. So,
right. You're right. That's created a situation that is quite unique. That is, I've never seen a situation where the inventory existing inventory was as low as it is now. I have seen a period of time when, in fact, the amount of listings coming on the market were about equal to where they were now. As a matter of fact, if I can go back to his in that slide that shows the number of sales. Now, not that one. Go back again.
The white.
All right. So if we take a look, this is kind of an interesting slide because it shows the interaction or interplay between the number of new listings coming on the market, which, by the way, is in the red bar. That's the red bar.
Right.
And the green bar, which is the number of sales that were reported. So one of the things you can see back in the 1980s when we were talking about the oil bust.
1984 is when that started to happen. 85, right. Y'all had the largest number of new listings.
Right. So you can see, here's the sales, here's the listings. Okay,
right.
Totally and completely doubling in many cases,
right.
or tripling of the number of properties coming on the market relative to the numbers of sales. What was happening? High unemployment. People were moving out of Lafayette, abandoning homes. We developed this huge inventory. And as a result of that, obviously, supply and demand. Supply exceeded demand. By the mid-1980s, we were ultimately, about 1985, we had gone from about a $95,000 average sales price to about a $55,000 average sales price. Okay, that's what over amounts of inventory will do. But then following that, okay, we started a recovery in the 1990s. Now, this doesn't look like a recovery, but actually the sales were drifting upward, okay? But what was happening, because of the oversupply that we got in the 1980s, we basically went through the whole decade where the ratio of the number of new listings to the number of sales was about 1-to-1. For every sale, you had one listing coming in. And that drove prices up because supply and demand started coming back into balance. And then we started back in the 2000s, and we began to see an excess again of listing inventory over sales. But because sales were going up, it didn't impact negatively, certainly not the impact that we had in the 80s. Right. And now if you look in these last couple of years, which were the COVID years of 20 and 21, the green numbers, the red numbers, new listings, still exceed the green numbers, but by a lesser amount. So we have seen, especially in the last few years, with that tremendous increase in demand, the amount of inventory going down. And because of that, even with higher interest rates, I don't see any kind of significant correction in Lafayette as far as values are concerned because of that lingering lack of demand, as a general statement, in most price categories. Okay, so I still see values staying relatively stable. What I do see is a more confusing market, if you will, because sellers aren't going to want to sell knowing, unless they have some assurance that they can find what they want if they have to buy again.
Right.
And that's going to be the conundrum of trying to match the supply and demand. As you point out, there's still plenty of buyers that are out there. And from a demographic standpoint, I think we can all look at that demographics, the millennial generation, and say that there's a rationale to believe that housing demand is going to continue to be moderately strong over the next few years, assuming interest rates and inflation don't get us totally out of kilter.
Right. Yeah, and so let's break that down a little bit more. I mean, when we're talking about inventory, so because what I'm hearing you say is, you don't see any major wave of inventory that's going to hit the market, that's going to really increase the supply so much so that we're going to see a price adjustment in the next, near future.
I don't see it.
Right. So even with the interest rates rising, we still have so much demand and not enough listings. And the only way to correct that is either the demand has to fall completely or we have to have this huge wave of inventory that comes on the market. And we're just not seeing that. We're not seeing the sellers. As you stated, the sellers are also reluctant to put their house on the market because they got to find a place to go. And now, as interest rates rise, you're probably going to see, I'm reading into what you're saying, but I think you're going to see some sellers say, you know what, interest rates have gone up. I can't make that move right now. We wanted to move up to another house, but now that same house is costing me too much. I just should stay where I'm at.
Right.
So we're either going to see the average homeowner stay in the house longer than what it is. And I know, like, even back in the 80s, one of the things I've heard that, I wasn't around back then. I was, but I was in elementary school. But I know that you guys, a lot of the issues that we probably will deal with, but just in a whole totally different manner, might come back, like loan assumptions. I would imagine, that might start to become a thing if interest rates continue to go up and you're able to,
It may. You find ways to adapt to the marketplace. One of the things that you can see, even looking at this chart, that there were, when there were there was a year when we had a significant amount of inventory. What happens? Well, the demand went up.
Yeah.
What happened? Well, people were dumping product on the market. In this particular case, a lot of that product was being dumped by the banks. So there were heavy discounting that occurs. Right. So at some point in time, somebody comes into the marketplace to make corrections when economic conditions get totally out of kilter. I just don't see that happening. I think that again, the demand relative to the supply is going to remain relatively strong simply because we have so little supply that is available, and new construction's not going to make up for that gap. And even if it could, it has its own set of problems, extremely high pricing going on as far as material costs, labor costs, supply chain problems, all of those.
We could do a whole show just on that.
That's not going to be the answer, okay? Right. It's part of the answer. It's not the total answer. I think what we may see, the next big unknown as far as potential inventory coming onto the marketplace would be what's going to happen when the baby boom generation, the me's, I'm now 71 years old. What happens when I pass away? And I'm part of that World War II, post-World War II baby boom generation that has kind of spurned the real estate industry through the 70s, the 80s, the 90s. We were the ones that were the primary buyers, and we bought our homes. and we're still buying homes, but there's a lot of inventory occupied by these baby boomers. What happens when we go away?
Right.
Okay. There is a housing stock nationally that's occupied by this huge generation that will ultimately be coming on the market. Now, hopefully, we're not all going to pass away on the same month or the same year, so that is going to be some kind of a trickle that comes in, hopefully a manageable trickle, but still there's going to be significant inventory coming down the pipe. Now, the real question is, what's the new generation, the millennials, how are they going to embrace that housing? Well, we were kind of confused about that over the last decade or so. New construction has been smaller square footage, open floor plans, those types of things, making a smaller home more affordable, but giving it at least a certain amount of spaciousness appeal, okay, but not in reality. Well, COVID kind of put the kibosh on that. And so we saw more and more of that younger generation that we would have expected would want new homes buying 1960s homes, what they call mid-century modern. Well, what's that all about? It's about square footage, in my mind. It's about that COVID changed what we perceived the utility of a house to be, and that's moved taste into a realm where square footage is going to mean more and more to people than it has had over the last couple of decades.
Right. Well, that's very interesting because I would have said it's a appeal to the architecture, but now I have a whole different perspective on the mid-century modern. It is square footage. It is the larger yard, for the kids to play. And personally, if you have kids, especially if you were at home for COVID, the open floor plan doesn't seem as attractive anymore, and you like to compartmentalize the house where you got the playroom, the formal living room, the other living room, the dining room. So it's an interesting thought there. But let's get back to values. Let's talk about values because we're talking about all kinds of stuff. What? Let me see. Let me look at Andrew. Throw on my. This is some national data that I've actually just pulled from. Let's see here. Yeah. So this is the the United States fourth quarter of last year. We saw a change in prices in Louisiana at 10.2, and Louisiana's on the bottom end of the country as far as values increasing. We're at around 10, which is enormous for us. Yeah. And Lafayette, we followed almost that, just below that, right, and right around 10% as well.
Especially when you think in terms of historically that what we've been looking at as the average increase in value for a home is something in the range of 3.5% to 4%. If you look over the last 20 years, okay, which is an enormous, when you think in terms of the compounding effect of time and percentage, is an enormous value there is to home ownership. To have a year where you're having double-digit increases in average sales price, as wonderful as that may seem, it's not sustainable.
Right.
It's not sustainable. No. So we all need to get beyond that. This is a unique time that we've lived through. Don't take these numbers as any kind of gospel or a predication of what's supposed to be in the future.
And if you look at just the last 5 years, it was 25%.
Well, 5 divided that by 5, it's 5 per year.
That's 5%. But over the since 1991, this data is from FHFA, and it was 234%. So I'm sure, especially when it comes to home buyers and home sellers who are like, should I make that move? Or, I know in 1991, people were saying, oh, these prices are too high. We shouldn't, it's too much. But I think pretty much anyone who bought a house in 1991 wish they would have bought 10 of them today based on the appreciation. And when you look at Lafayette, specifically, although we've had enormous increase in the home values, just the last 2 years. If you look at it over the last decade, it's really under 3% appreciation per year when you take the last decade and look at the home value. So it's not, it's not outrageous as, like California and, Oregon, 80% appreciation since 1991.
And what do you ultimately read next to those headlines that you're going to have nationally that tout that? You're going to probably have an article right next to it talking about the exodus of people from that state to other states.
Right.
Because one of the things that COVID has brought on is the idea that some places are just too darn expensive to live in.
We've seen that, and we're, because as you know, we're generating leads from all over the country, and we've seen an uptick of people wanting to come to Lafayette because of affordability. Tommy, our videographer, is from New York. He moved here because he was in a $800,000 apartment that's only 2 bedrooms at 800 square feet. And so, when the prospect of, wait, I can get a $300,000 brand new house with a nice backyard for half the price of his apartment, it starts to. I know that was a big reason you moved down here.
Everything is relative.
Right.
Everything is relative. But go ahead.
But with this, like you said, you're also going to have. Let's see here. This is every single time prices start to go up, I hear on the street, is this a bubble, right? And this stat was done by Realtor.com. 77% of consumers think that we're in a housing bubble, or a housing bubble is coming this way. 44% of agents think that we're in a housing bubble. So,
I guess it's all semantics. If what you say and the connotation of making the statement we're in a housing bubble means that you believe it's going to burst, okay, that we're getting ready to have a crash,
right,
then I think you're overreacting. If you mean
this is 3 out of every 4 people.
3 out of every 4 people think that we've been living through times that were atypical to what is normal, then I would agree with that 77%. Okay?
Right.
That what we've seen over the last 2 years is not sustainable. It's not normal. It's abnormal. Therefore, we're going to get back to normal. But there are some things that are going to mitigate that transition to normality. Sure. One of them here in our market and in markets throughout the country is that lack of inventory, which is probably going to help sustain the demand quotient relative to supply being excessive.
Right. So actually that brings up a perfect segue to this next chart. So yes, and I exactly what you had said, we're not in a normal market. We know that it's not sustainable. However, there are the buyers out there that we're dealing with. Their concern is, hey, if I buy this house, will I be able to sell this 5 years from now? And they do think that, like, maybe I'm buying at the top of the market and I'll never be able to sell my house. We have those conversations on a daily basis with our consumers.
Sure.
And but what we try to explain, and there's other ways for things that can impact this, but it's nothing like it was in the Great Depression, the 2008 when we had the recession. 4 years ago we had. This was the national average month of supply and inventory, and you could see we're nothing like that. Where the inventory, just to support what you were saying, that's going to most likely deter any kind of burst of the bubble.
That's
because
correct.
There's no wave of inventory that's going to hit the market anytime soon. This year we're not going to have double the amount of listings come on the market. It's just not going to happen. So that what in turn is going to keep the price of the houses. And this is also involved, nothing like last time as far as like in 2003 to 2007. That was driven by lack of lender standards.
Right.
And you can see here, this is from the Federal Reserve. This is the volume of loans in billions with credit score under 620. And obviously, you can see the restrictions and
they've worked.
they've worked, and people who are buying houses can afford them. Whereas in 2003, 4, 5, we called them, you didn't have to prove anything. You just said, yeah, I can afford it, and they would give you this loan. And then they got into trouble. They couldn't afford it. But the buyers that are buying houses today and have been buying since 2010 are in a different position than they were back when we had the bubble burst in 2008. So anyway, I thought that was a very interesting data.
Absolutely.
And then this was, the months of supply, right? And then it goes to
was for existing homes in Lafayette. Existing homes through February, we had a 1 month supply product. Basically, lowest I've ever seen. There were only in Lafayette Parish resales. There were only 259 active properties available, and all price points. Another kind of interesting anomaly that I think we're experiencing, and I don't know if that'll ever reverse itself, is that the affordable housing, quote unquote, is becoming less and less affordable. Going back again to 2011, I looked at, and if we're just looking at resales in Lafayette Parish in 2011, under $150,000. If you bought a home under $150,000 in 2011, okay, 41% of our sales were under $150,000. Okay, in 2022, as of February, only 17% of our sales are under $150,000. So what's happened to them? Interest rates have gone down. What's happened? Well, a couple of things. Number one, the COVID economic impact, as we've learned from economic studies, impacted people with lower incomes the most in Louisiana. That is, people who work for restaurants and hotels, the leisure industry. Those lower paying jobs were the most impacted, and those were the people that would typically be buying in that lower income. Lower price range, excuse me. Then you had interest rates that lowered, so affordability increased. And so what that typically did was it moved what would have been those affordable people, okay, into a higher price point, that 150 to, let's say, under 300,000, which back in 2011 was only 46% of our sales, and in 2022, through February, are 56% of our sales. Right. So we have a movement up there, and then that movement is even evidenced when you go up to the 300 and above, where back in 2011 you had only 13% of your sales, and now today we have 27% of our sales. So we've had this quantum shift, and I'm not away from, quote, affordability, and I don't know how we're ever going to get that back. I don't know how you build or replicate today affordable housing in light of the price increases that we've seen over the last, let's say, 3 to 5 years.
Well, just an idea is, with that, so does wages have to rise. So
sure, as
wages rise, the $200,000 house becomes the affordable housing for. That's the only way to correct that, right?
It is, and I think
because you can't build a house anymore under $200,000. It's almost virtually impossible to build a house under $200,000.
So what's going to happen is that there's still going to be people that will make the decision I want to buy. There just may be fewer of them, and those people who are going to make that decision to buy are going to be willing to buy up, because the number of steps that you traditionally took to get to your optimum housing has been reducing over time. So you make fewer decisions, then there are greater leaps, and there's less people making the leap.
Well, I thought that this pertains to this because, we're talking about, people buying. Is that me?
That's me.
That's all right. I find it really interesting that, first of all, there's no signs of any kind of busting of a bubble happening anytime soon. It seems so far-fetched. There's just no way to increase the inventory at such a level that we're going to be able to fulfill all of the demand. I think we're going to be moving that direction. But also, if you believe in inflation, or if inflation's happening, we see it happening now. The question is it a temporary supply chain issue, or is this going to be something that we're living with for the next decade? And if it is, and if you believe that, you can see home ownership is the only real hedge against inflation. And almost in every decade, except for in the 1980s where it was slightly more, the home values rise at a higher rate than the actual inflation. So it's the only strong hedge against inflation is to buy a house. And then, if you look at rent, right? So what are your options? If you're a homeowner, you can if you're renting, you can either buy a house and hopefully create some wealth, and hopefully the value of the house that you buy is going to rise at a greater rate than inflation does. And we've seen that over the last 5 decades, that's what's happened. And rent typically, as you can see in this chart, rises with inflation. I mean, you've had some dips here, in different time periods, but this is from 1973 to 2020. Rent is the green line as far as rent values, and then inflation is the blue line. So it's an indication that rent is normally going to increase with inflation. And this is since 1988. This is a national average. Since 1988, rent has done nothing going up. So it becomes almost mission critical for the renter to understand, hey, there is no bubble busting. If you want to create wealth and if you want to protect your family and protect your investment, rent is not the way to go moving forward. It should be now buying and remove the fear of, are you buying are you spending too much now, and because we're in a bubble and it's going to burst any day now. I just don't see that happening.
I agree with you. I agree with you. I do. This has been always the situation is the alternative to the freedom of home ownership is the imprisonment of rent.
Right.
And that most people who are in the rental situation, or at least historically, were forced to be there. They didn't choose to be there. There was some popular thought following the Great Recession, if you will, of 2008, that perhaps the new generation, the millennial generation, was a generation that just didn't want to buy. And part of that may have been that they saw what happened to values in that decline in the Great Recession. Right. At least that was the thought. The conventional wisdom. But what we're seeing is just the opposite of that. It's occurring. They've been in a shell, if you will. And then maybe there were a lot of factors for that. Maybe they were forming families later in life. Maybe it was that they had college debt. Maybe it's because you're paying $60,000 for an automobile now, instead of $30,000 for it.
If you can get an automobile.
Number of factors, if you can get one. Okay, but what we certainly have seen is in the last couple of years, and it seems that it's not going to stop, is that the number of 35 to 44-year-olds, those millennials that make up that huge bubble of about 5 million potential buyers that are out there, that they're coming back into the marketplace. Right. And I think they're going to see your example as the guidepost, if you will, to say, we need to think in terms of home ownership.
There's no renter in the last 4 decades that bought a house and wish he still rented. It just doesn't exist. If you bought a house anytime in the last, in the last 2 or 3 decades, you're
as a general
more
statement,
wealthy than you are now.
is a general statement. You're correct. That doesn't mean that you won't have ups and downs. I mean,
Sure.
just in any kind of investment. I buy a stock and it goes down 20% the day after I buy it. That doesn't necessarily mean that I've lost anything. I just hold it.
That's right.
And it may come back. Well, the same thing, when you look at the long-term charts in real estate, they all come back.
Right.
Now, if you sell in the dip, you may lose, okay? That's true. One other thing that we don't put enough emphasis on also about home ownership is the impact of leverage. Leverage says this: if I buy a $200,000 home, and 5 years later, it's worth, let's say, $250,000, 10% per year increase. Okay, so when I bought that house, I didn't pay $250,000 for it. I might have had a down payment. Let's say I had $15,000 total into the house.
Right.
Okay. Down payment, closing costs. I sell it for $250,000 5 years later. So I have a $50,000 gain. That $50,000 gain is not a return on $250,000. It's a return on $15,000.
That's right.
So I've made $50,000
exponentially
on $15,000 investment. Okay, that was a 10% return on the total investment. That's the power of leverage.
Right. It's interesting you said that because it's dead on, and most people don't save 20% and buy an $800,000 house.
That's correct.
They buy a $200,000 house. Then they live in it for a little bit. Then they sell it and they sell for a profit. Now they buy a $500,000 house. And now they live in there for 5 years and then sell that. And now they have the down payment for the $800,000 house. So I think that's an interesting fact.
Right.
Nobody's saving up to buy an $800,000, $900,000 house. They're getting most of the time it's from the sale of another house, and that's from another house.
Right.
And so it just keeps growing. Well, I think this is it. I know we've blown through our time, but before we end, I do want to talk about baby boomers. You brought it up already. My parents are older than you, but they're in that same dilemma. They have the big house that our whole family grew up in. What should they be thinking about doing? Should they? I mean, what would you say for that demographic? Is it time to downsize? Is it a good time to sell? Should they sell now, or should they be worried that upper end price house in the let's say 500 and up? Is it a good time to sell, or would it be detrimental by waiting to sell?
Yeah, it's an interesting question, and it certainly impacts me. In a number of ways. I certainly have struggled with that same thought. My wife and I, we lived in the same house now for 30 years. That's unusual, but it's a very large house. We've raised our kids in it. They're all gone now, and so we have this 5,000 square foot house where two people live in it. And sometimes we lose track of one another in our house. Should we move? Should we downsize? The conundrum is, and we go through that, is what are we going to do with all our stuff?
Right.
What are we going to do with our stuff? And so and you're in the business, brokerage business, I'm sure you see it. What happens in reality is old folks like us, when we buy, we're really not downsizing, we're upsizing in a different manner, a different lifestyle. So you're still selling these big houses, they're just a little bit different.
Right. Yeah, and what you mean by that is you're not downsizing in value, you're downsizing in price.
Yeah,
you're
downsizing maybe a little in square footage, or numbers of bedrooms or whatever.
Yeah.
Right.
Like if you're coming from a $700,000 house, you're probably going to buy
a $700,000
house.
Right.
It's just going to be smaller and less maintenance.
Right. So that being said,
it's not about the price or the value, because you guys have the money to afford the house. It's about the size and the convenience and the maintenance.
And that would be what I would stress, is if you have the capability financially at this point in your life to not have to worry about it, don't worry about it. Okay.
Right.
Because what's going to happen? Is this the right time for us to sell, or is it not the right time to sell? Well, we don't owe anything on our house, so whether I sell today or whether I sell tomorrow,
it's not going
to make any not enough to where I'm going to lose sleep at night over
it.
Right. Okay. That being said, once you're gone, it really doesn't matter. But I'll use this as an example. My mother-in-law passed away this past year. She and her husband lived in their house on Duchamp Court, Greenbrier. Nice house, quite dated. They lived there for some period of time, but nice house. They passed away. She passed away in July. We finally put the house on the market maybe a couple months ago, and it's priced at about $550,000. Okay, we thought it would go like that because of location, nice house. It hasn't. It's still on the market. And we're kind of struggling with that idea, but not too much now. We've had what we came to terms with is it was outdated. Okay, we needed to paint it. We've painted it now. Now we're fixing it up. Next, we're going to have to approach on price. The reason I'm bringing all this up, I'm in the real estate business. We don't hit it. We don't hit it out the park every time we swing at it.
Right.
Okay. But one of the things that I noticed when I go back into my price points and the number of months supply, that in that $550 to $599 range, there have been 5 sales through February. There's 5 properties that are currently on the market. There's a 2-month supply product. So what would happen if we reduced our price to, let's say, $450? Okay,
right.
$450 to $499. Drop it 50,000. Now we go into a price point that instead of having 5 sales, we have 20 sales in 2 months. And there's only 24 properties on the market. So it's a 2.4 month supply of product. So I actually would gain a little bit by reducing the price. Right. So those are things you got to look at.
Sure.
If I went to a smaller price reduction, I actually don't get a better number of months supply of product. So then logically I ask myself, well, if I reduce it to this price and my chances of selling it don't increase, then why would I do that? And the answer is you wouldn't.
Right.
I got to have some justification for it. And so what we would hope to provide you with some kind of sense of what's really happening in the market is the ammunition to be able to make logical decisions. And if those decisions don't point to say, hey, if I reduce the price, is something going to happen? And the logic says, well, it doesn't really look that way, then don't do it.
Right.
Okay. But if you need to have a real estate representative that can show you that. Because you don't want to leave money on the table. That being said, your objective is to sell the property.
That's right. Yeah. Mr. Bill, you're obviously very passionate about the numbers, and I can't thank you enough for sharing this information with us and with the public. So thank you for coming today. I really appreciate it. Is there any final words you want to share with us on, where you think the state of the Lafayette or Acadiana market is going to go?
Well, let me just leave you with this thought. It's a quote that I use an awful lot, and I think there's a lot of validity to it. There are 2 kinds of statistics. There's the kind that you look up, and there's the kind that you make up. You want to be dealing with statistics that you look up.
Right. There's enough made-up statistics out there.
Yeah, and again, it's not being specious. It's that a lot of us think in terms of the market as a whole is defined as what impacts me personally. And the answer is that's not correct. The market is the market.
Right.
Okay? So if I'm having success, that doesn't necessarily mean the market's successful, and vice versa.
Right. No. And I know that's your broker coming out, training those agents about that. Well, man, the amount of knowledge and information you have is unbelievable. We're very grateful to have you here in Lafayette, to have somebody like you to be able to break down our market the way you do is phenomenal. So
you're too kind. I woke up this morning and I was having a 71-year-old dream, and I startled awake and I said, I forgot everything I'm supposed to say there.
Well, it just it comes out naturally. But listen, next time I hope that you'll come back, and I hope next time we can even break out, because we do get questions about the outlying parishes and how that's affected, and I know you got a lot of data on that. So until next time, Mr. Bacque, thank you so much. Really appreciate it. I'm Jim Keaty with Keaty Real Estate, and this is Real Talk with Jim.